you more inclined that people go for property, i.e. residential property, or commercial? Can you buy a residential property and a commercial property?
You certainly can do both. Residential is probably the more popular for the average Australian person. Some of the bigger funds tend to gravitate towards commercial property. And commercial can work really well if you're an owner-occupier. I think it's very important to realise that there are strict rules around self-managed super. So if you do invest with your super funds in a residential property, you can have no connection to that property, i.e. you cannot stay there.
Family?
No one else that you know can stay there. You can't have any sort of personal transaction with that property. However, with commercial property, you can own or occupy your own property that's owned by your own fund. And that's probably the single best way commercial property works with SMSF. And it is very lucrative, and a little bit about leverage, that how self-managed super fund works in general, because you control your own investments, you control your own levels of insurance with self-managed super. And leverage, which we'll cover up a little bit later on, is probably the single biggest advantage of starting a self-managed super fund. To give you more dollars at the end of the day, basically. Less than 20% of people get advice in this country, so you consider that there's a good 80-odd% of people never seen an advisor. They're most likely to have a retail fund. And 80% of that number, we're told by the Industry Super Fund Association themselves, are in a balanced fund, because that is the default fund. So 80% of the 80% have never had advice, probably don't know even what they've got, where it's invested, how much insurance they got, where they're going to land. So there's a lot of untapped potential in it. But if we compare that to the average Aussie probably looking at a self-managed super fund, it is quite topical. I'll hear about it from their mates or at a barbecue. If we have a look at, say, the average industry fund now, Q Super, Sun Super, Australian Super, they're spruiking their 10-year performance around about 7 or 8% per year. And if we compare that to, well, what happens if someone with 200,000 goes and buys an investment property with their self-managed super fund? What's the average property? We'll say it's 600. So arguably, we can get them better return than what they're getting with the industry fund, but we'll use the 8% number of the 200. Now, if they don't use self-managed super and buy a property, they're going to get 8% of the 200 as their long-term average. Now, this is the key benefit, and people like your firm and your loan writers can come and really help and be good partners with them to grow their superannuation base, is because if they can leverage, which is just a financial term for borrowing to invest, if they can leverage their super, they take their 200, use that as deposit to borrow another 400 and buy a property for 600, they now technically have 600 in the fund, albeit they owe 400. But they're now earning 8% of 600, not 8% of 200. And that leverage, that ability to borrow up, scale up, is what makes self-managed super works over time. Now, depending on, we're not property experts, and we won't hold ourselves out to be property experts, but a lot of them out there are saying the long-term average, you'll do a lot better than 8% with the property. We're not experts. We do advise you to go and see someone who's licensed specifically in that area. If you look at leverage in itself as a financial concept, that's what makes self-managed super fund
that's a good one,
a really attractive proposition.
That's interesting.